Welcome to this brief introduction to CFDs and CFD trading. Here we're going to take a look at what CFDs are, what CFD trading is, going short the market, leverage, risk management and markets. So let's dive straight in. A contract for difference is a contract between two parties to exchange the difference in an instrument's price from when the contract opens to when the contract closes. CFDs allow traders to trade in the price movement of a range of instruments, from securities to commodities and everything in between. Derivatives are financial investments that are derived from an underlying asset's price. CFD trading is the trading on the price movement of a market without actually owning it. So this is the key difference to share dealing, where you physically own the share. In CFD trading, you don't own it. As I said, you're trading on the share price or instrument price movement. So for this reason, it's possible to make money in a rising market if you go long, or you can make money in a falling market if you go short. So let's take a closer look to see how CFD trading works through an example. So if you buy 5 CFDs in oil and the oil market rises from 7,000 to 7,020, so a total of 20 points, you close your position. You would make 20 points per contract. On 5 contracts, so 5 times 20 is $100. If the price of oil fell 20, then you would lose 20 points on 5 contracts, so same again, $100. And this would be in dollars because oil is traded in dollars as a base currency. And CFDs are traded in their base currency. Now this example is based on a commodity and an index, but if you're looking to use a CFD to trade shares, then it really becomes a bit simpler due to the fact that a CFD price movement mirror images the market, and the CFD price on a share is the same as the actual share. Say for example, if you usually buy shares in Lloyd's and you usually buy £5,000 worth, then it's no different calculating a CFD position as it is a share position. Say for example, Lloyd's trades at 50 pence. £5,000 divided by 50 pence is 10,000 shares. And it would be the same if you bought £5,000 worth of stock. The difference comes about from the leverage, and with most equities requiring a 20% deposit, you would only use £1,000 for the position instead of a straight cash purchase of £5,000. So as I said at the beginning, it is possible to make money from a falling market, and this is called going short. If you think that the FTSE index is going to fall, you might decide to sell at 7,200. So suppose the FTSE falls by 50 points, you'd make your stake multiplied by the points moved. So in this example, it would be 5 contracts times 50 points, which is £250 profit. In pounds, because the FTSE of course is traded in pounds sterling. But suppose that the value of the FTSE actually rose by 50 points. Then your position would make a loss of 5 times 50, a £250 loss. Going short is useful not only to make money out of a falling market, but it can also be used to hedge a share portfolio in a downturn, protecting your wealth and ensuring your portfolio. Another key point about CFD trading is that it's traded on leverage. So what does this mean? Trading on leverage means that you only put forward a percentage of the value of the trade in order to open it, rather than putting forward the full amount. So again, this is probably best understood through using an example. If you were to buy 500 CFDs in Rio Tinto at a price of 5,180 pence or £51.80, then the total value of your trade would be 500 times £51.80, which is £25,900. The margin for Rio Tinto is 20%, and this means that you need to put forward 20% of the trade value as the deposit for the trade. So this works out as £25,900 times 20%, which is £5,180. So in order to open a trade of 500 CFDs in Rio Tinto, you need to have a minimum of £5,180, but you would still have exposure to the full trade, which is worth £25,900. Now it's important to realise that the gains or losses that the trade makes will be according to the full value of the trade. Now whilst the trade goes in your favour, that is great. However, if the trade goes against you, it's important that you have a buffer in your account. For this reason, when I say a minimum of £5,180, you actually want to have more than that to allow for some volatility in the trade. It's vitally important to ensure you do not over-leverage yourself and get caught out. Let the CFD do the work. So if your usual trade size is 5,000, then keep doing 5,000 and only use 1,000 as margin. Don't use 5,000 as margin and buy 25,000 worth, as you'll soon find yourself in a position a lot bigger than you're used to. Trading on leverage is great in that it means that you can make your money work harder for you. Instead of having it all tied up in one trade, it can be used for other investments or other trades. However, trading on leverage is also risky, especially if you get greedy and try to do a bigger trade than usual. Therefore, there are certain tools which you can use to stay more in control. These, of course, include stop losses, which do, as they say on the tin, they stop your position at a certain price to prevent further losses.